Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 108 on April the 4th, 2020. I'm your host, Eric, and in this week's show, we will cover the trades from last week on Schlumberger, the Gold Trust ETF, and the S&P 500 Bear 3x ETF. And we discuss three new trades on Haliburton, Advanced Micro Devices, and the iShares Russell 2000 ETF. So it's always great to hear from listeners. If you have any questions about the trades presented here on the show, or even about your own positions, feel free to email me. You can reach me at eric@theweeklyoption.com. That's ERIC at theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. The equity markets finished lower this week, and the markets are clearly trading based on coronavirus news here in the US and across the world. The Dow Jones Industrial Average lost 584 points this week, ending at 21,052 points. The S&P 500 index fell 52 points to close at 2,488 points on Friday. So now it's time to discuss the topic of the week. And the topic of the week this week is the language of options versus the language of trading. The in the club language for option traders are the risk sensitivities known as the Greeks. So you have delta, gamma, vega, theta, and rho. And you guys know I don't really like to talk about those risk metrics on this show, mostly because they confuse a lot of people. And not just regular investors. I know many professional traders who will tell you on the one hand that they know about all the option risk in Greeks. And then as you start to have a dialogue with them, you realize that they don't fully understand how not only the definitions, but how to use those risk metrics to actually improve their trading. So professional option traders hedge their positions to isolate changes in volatility and limit exposure to underlying stock moves. Most non-professional traders don't hedge. They actually want the position to benefit from movement in the underlying stocks. So that's the reason I'm able to discuss option trading without using that sort of language of options. So when it comes down to it, look, the delta, for those of you who want to know, delta is a risk metric that lets you know how much your option position is going to change based on movement in the underlying stock. Gamma tells you how your hedge, your delta, is going to change. So if you don't hedge the position, then the gamma is irrelevant because you don't have a hedge on. Delta is your hedge metric. So I'm able to talk about option trading without using terms like delta and gamma because most of you aren't going to hedge your option. So you're not going to, say, buy a call option and then sell stock. You're not going to buy a put and then buy stock. You don't think about it that way. You buy a put because you expect the market to go lower. You buy a call option because you expect the market to go higher. So rather than focus on those sorts of risk metrics and that definition, I'm able to speak using the language of trading. And that's why on this show, we focus on the language of trading. So what is the language of trading? This language affects all trading. It makes sense whether you're talking about trading stock or trading bonds or trading cryptocurrency or regular currencies, right? So the language of trading includes terms like profit and loss, P&L, right? Your break-even point, risk. Like those are the metrics I want you to be able to discuss and understand. So profit and loss actually, it's pretty clear. Are you making money? If you made money, that's profit. And if you lost money, how much did you lose? That's P&L. What's your P&L for the year? Your profit or your loss for the year? Your break-even point is simply the point at which your trade is making money. right? It takes into account the money that you put into the trade. So if you buy an option, your break-even point is the point at which that option is in the money by more than what you paid for it. If you sold an option, it's the point at which the option has actually moved against you to the point where it's pulled back all of the money you received when you sold that option. That still applies in futures trading. It still applies in bonds and all of these other things. And obviously, risk is a metric to help you understand how the likelihood of your position to lose money and possibly cost you more money than you've either collected or put at risk. So how much money could you lose on this position? If I buy an option, your risk is the amount of money you paid for the option. If I sell an option, your risk is the amount of money that can be lost beyond what you received when you sold the option. So those are the metrics that matter. If you get really good at understanding those metrics, you'll be able to trade options for a profit and any other investment tool. Options are simply a tool, right? So options are a tool for creating the risk position that you want and to use for profit in this market. You can use futures to create spreads. Many guys trade future spreads. So they'll trade a March versus an April versus a May in futures. There are a number of spreads that still work in futures that are used in options. And at the same time, like all of these metrics still matter. Profit and loss. What's your break even? How much risk are you really taking on for your position? And if you get good at those and you start making money trading options, then, reach out to me. I can definitely teach you how to use all of the Greeks to make more money. I can teach you why delta matters or how gamma is going to affect your position. Or, we talk about vega, theta, and rho. I can teach you all of those things. But when it gets to just starting out, if you're not learning how to trade options profitably without those Greeks, if you can't trade options without the Greeks, then let's start there. How about I teach you how to make money with just options, and then we can make it more complicated later. But if you can't do it without the complication, there's no point. Like, you've got to understand options, and that's why I'm able to teach you guys on this show and discuss options without using the Greeks. So that's it for this week's topic. Email me. Seriously, I do respond to email. Reach out to me if you guys have any questions, and thank you to the ones who do. I get a kick out of just knowing that you guys listen. So thanks for listening to me. And, if you want to learn more about options, reach out to me and I can show you a few ways where you can learn some more things about options, even the Greeks if necessary, but you don't need to learn the Greeks to learn options. I wish when I learned options that they had started me more in a scenario where we just talk about where we make money and lose money, not being sort of inundated or burdened with having to learn the Greeks. I appreciated learning the Greeks. It helped me understand the business, but it didn't teach me how to trade options from home or how to create risk positions successfully that would make money for different companies. So that's it. Let's get into the trade review for last week. So we did looked at a cover call on Schlumberger, symbol S as in Sierra, L as in Lima, B as in Bravo. The stock, when we looked at it, was trading for $13.76 a share. We looked at buying that stock and selling the April 14 call against it, collecting $1.67 for that call, and hoping for a max return of 13.88% in 3 weeks. Well, Schlumberger stock gained 53 cents this week, closing at $14.29 per share. The April 14 call we sold against the stock is now in the money. So you can buy the call back for $1.47, which would be a loss of 20 cents on the options. And you've obviously gained the 53 cents per share in the stock. But we know ultimately that this trade worked and will continue to work as long as stock remains higher than $14 per share at expiration. As long as it's higher than $14 at expiration, this stock will expire with the call option that's in the money, and ultimately your full collection, the full amount that you'll receive on this ends up being the 13.88% return on your capital for the trade. So this one worked out. Our next trade last week was a credit spread. We looked at the Gold Trust ETF, symbol G as in golf, L as in Lima, D as in Delta. So GLD was the symbol. And at the time, the stock was trading for $152.25. We looked at selling the April 152, 151 put spread and collecting 40 cents, which, of course, it's a $1 wide spread. So there's a maximum possible loss of 60 cents on this. So GLD shares gained 40 cents this week, ending the week at $152.65 per share. Our out-of-the-money put spread we sold is even more out of the money, so that's great. The spread has gone up in value due to increased volatility, but we know that if this spread remains out of the money, which it is right now with stock higher than $152 per share, this spread will expire worthless in 2 weeks. We've only got 2 weeks left in April. So I would normally consider, you could sell a call spread against this trade and turn it into an iron condor. So if you were to look at selling the April 156, 157 call spread against this, you would actually collect another 19 cents. So in all, you will have collected 59 cents of premium for this total trade if you do that. And that also lowers your risk to 41 cents. So, in doing so, that creates a scenario where stock needs to finish between $151.41 and $156.59 in order for you to profit. So you basically have about a $5 wide movement in the stock that where it is right now, where you could end up making profit on this trade and all. The most you could lose on the trade, of course, is 41 cents now, because you will have received 59 cents and both spreads are $1, and only one side of that spread could finish in the money at most. So right now, with stock where it is, if you were to sell that call spread against it, it creates a $5 range in the underlying stock that is a profit range for you. And the most that you could lose if stock either went down a bunch or went up a bunch is 41 cents, because you've actually collected 59 cents on a trade. If you decide not to add that call spread to this trade, you just stick with the original put spread, that's fine too. The most you could lose is 60 cents if stock goes lower than $152 per share. Your break-even point right now is $151.60. That's the break-even on this. So as long as stock stays above that, then you're going to walk away with the profit on this trade. So that's it. We've got 2 weeks left in April. So this trade worked, and you definitely would not look to close it anytime soon. You would just look to kind of ride it out unless stock really does go higher. If it continues to rise, like right now it's $152.65 per share. If it stays here or goes higher, this put spread is really going to start losing a lot of its value. And you might get to the point where it's worth buying it back in and just closing out the position. But it all depends on the amount of risk you're willing to carry. So that trade worked. Our final trade last week is a debit spread. And we looked at this daily S&P 500 Bear 3X ETF. Symbol S is in Sierra, P is in Papa, X is in X-ray, S is in Sierra. So SPXS. At the time, the stock was trading for $16.90 per share. We looked at buying the April 15-16 call spread for 50 cents, which means that's a $1 call spread. If we pay 50 cents, that means our maximum gain is another 50 cents, or you've got a possibility of 100% return in 3 weeks. Well, the SPXS, ETF finished the week 65 cents higher. Now remember, this is a Bear 3X ETF, so when the S&P goes down, this ETF actually goes higher. So because we finished lower in the S&P, this stock went higher, 65 cents, closing at $17.55 per share on Friday. The in-the-money call spread we bought is even more in the money. So the spreads are so wide on both options of this spread that the market price looks like a loss, but we know that this trade is in the money and it's going to expire being worth $1 in 2 weeks if this ETF holds a price higher than $16 per share. Right now, it's trading for $17.55. So we are $1.55 higher than our upside call that we bought. So ultimately, right now, like if it stays higher than $16 per share, this thing will be worth $1, and we'll collect our 50 cents, which is a 100% return on our capital. So for those of you who don't want to wait until expiration, you might be able to offer this spread out, this week for 80 cents or 90 cents. If you did so, that would still be a 60% or 80% return on your capital in a very short amount of time. So I love it when these trades work, especially if I can buy a spread for 50 cents and know that I can make 50 cents on it. That's unreal, right? Making $50 on $50 of spend in such a short amount of time is fantastic. You would not have gotten that even if you were to try and get that return on just the underlying ETF that you pay $16.90 for. It would have to go to $37.80, right, for it to double. But you can buy an option for $50 and then make $50 on it in a very short amount of time. That's what I love about option trading. So that's it for the trades for last week. Let's talk about 3 new trades. And we've only got 2 weeks left in April. So these 3 trades are all April trades, but they all have very short time horizons. So that limited time horizon does make these trades a little bit more high risk. Next week, we'll definitely be looking at trades for the month of May. So know that these 3 trades might be a little higher risk simply because the shorter amount of time. I use my normal risk metrics for them, but the shortened time means that you don't have a lot of room to be able to alter a trade that moves against you. So take them, decide if it's part of your risk portfolio, if there's room for your risk portfolio for these type of trades or not. But I definitely wanted to share them. So we're starting off with Haliburton. Haliburton, symbol H is in hotel, A is in alpha, L is in Lima. It closed this week at $7.61 per share. I'm looking at buying that stock and selling the April 8 call against it. You collect 70 cents for that at the money call option and hope for a maximum return of 14.32% on your capital in 2 weeks. So you enter this trade by buying Haliburton stock for $7.61 per share and selling the April 8 call at 70 cents. This trade makes the most money if stock prices finish higher than $8 per share, and the break-even price on this trade is $6.91. In real terms, you'll pay $761 to buy the stock, and you would collect $70 for selling the option. Our next trade on the week is a credit spread. We're looking at advanced micro devices, AMD, symbol A as in alpha, M as in Mike, D as in Delta. The stock ended the week at $42.59 per share. I'm looking at selling the April 43.44 call spread at 42 cents, which could yield a maximum possible loss of 58 cents per spread. So we're selling the at the money call spread, or just out of the money. You enter this trade by selling the April 43 call at $1.96 and concurrently buying the April 44 call for $1.54. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices remain less than $43 per share. Our break-even price, of course, is $43.42 per share. So in real terms, you would receive $42 per spread that you sell and have a maximum risk of $58 per spread. And we want stock to stay lower than $43 per share when it expires in 2 weeks. And then our final trade on the week is going to be a debit spread. We're looking at the iShares Russell 2000 ETF, symbol IWM. I as in India, W as in whiskey, M as in Mike. I used to trade this actually on the floor of the CBOE in Chicago. So this is an ETF that I know fairly well. I'm looking at buying, the stock ended the week at $104.62 per share, and I'm looking at buying an in-the-money put spread, the April 106-105 put spread, paying 64 cents for this spread, and hoping for a maximum return of 36 cents or a 56.25% return on my capital in 2 weeks. Now, you enter this trade by buying the April 106 put for $5.32 and concurrently selling the April 105 put at $4.68. This is a debit spread because we are buying the spread. This trade makes the most money if stock prices remain below $105 per share. The break-even price on this trade is $105.36 per share. And in real terms, you'll pay $64 to enter this spread, and your maximum gain is $36 per spread. So that's it for this week's trades. Thank you guys for listening. Definitely share this podcast with other people that you know who trade options or hope to start trading options. And be safe out there. This coronavirus is obviously growing and spreading here in the U.S. and around the world. So take all the precautions needed, whether that's staying home or wearing a mask when you go out or just limiting exposure to other people. So that's it. And don't be afraid of these markets. Dive into these markets with the knowledge that you have of option trades so that you can make good, appropriate risk and make money. So that's it. Be safe, stay healthy, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.